Welcome to this basic bookkeeping and accounting study guide, part 1 of 4 from TestMole.com, where employers can test candidates and teams using pre-built or custom assessments. We also create free tests and guides like this. Please help us by liking this video. Subscribe for more study guides and free tests. And turn on notifications. Okay, let's begin. What is the fundamental accounting equation that governs the statement of financial position? The accounting equation is the bedrock of double-entry bookkeeping, ensuring that the statement of financial position, balance sheet, always balances. It represents the relationship between what a business owns, what it owes, and the owner's stake in the company. Assets, resources controlled by the entity, e.g., cash, inventory, machinery. Liabilities, obligations to transfer economic benefits, e.g., loans, trade payables. Capital, equity, the residual interest in the assets after deducting all liabilities. Refer to the diagram on screen. Let's review the options. A. Assets equals liabilities, capital. B. Assets equals liabilities plus capital, equity. C. Assets plus liabilities equals capital. D. Assets equals revenue, expenses. The answer is B. The equation must balance because every asset is funded by either borrowing, liabilities, or owner investment, capital. Options A and C incorrectly rearrange the mathematical relationship, while option D describes the calculation of profit, not the balance sheet structure. If a business buys machinery for £5,000 in cash, what is the correct double entry? Double-entry bookkeeping follows the principle that every transaction has a dual effect on the accounting equation. To maintain balance, every debit must have a corresponding credit. Debit increases an asset or expense account. Credit decreases an asset or increases a liability/equity account. When purchasing machinery with cash, the business gains a non-current asset, machinery, and loses a current asset, cash. Here are the options. A. Debit cash, credit machinery. B. Debit machinery, credit cash. C. Debit expenses, credit cash. D. Debit machinery, credit capital. The answer is B. Debit machinery to record the increase in assets and credit cash to record the reduction in assets. Option A is the reverse, while options C and D incorrectly categorize the transaction as an expense or a capital injection. Which of the following is classified as a current liability? Liabilities are categorized by their maturity date. A current liability is an obligation expected to be settled within the entity's normal operating cycle or within 12 months of the reporting date. Trade payables, short-term debts owed to suppliers for goods or services purchased on credit. Non-current liabilities, obligations due after more than 1 year, such as long-term bank loans. Assets, items like inventory and buildings are resources, not liabilities. Possible answers are A. Bank loan, repayable in 5 years. B. Trade payables, money owed to suppliers. C. Inventory, stock. D. Office buildings. The answer is B. Trade payables are short-term obligations due to suppliers, making them current liabilities. Bank loans are non-current if due in 5 years, while inventory and buildings are assets, not liabilities. Which financial statement reports the performance of a business over a period of time? Financial statements serve different purposes in reporting business health. While the statement of financial position acts as a snapshot at a specific date, the statement of profit or loss, also known as the income statement, acts as a video of performance over a period. It summarizes revenue, income generated from operations. Expenses, costs incurred to generate that revenue. Profit/loss, the net result of the period's activities. Choose between A. Statement of financial position. B. Statement of profit or loss. C. Trial balance. D. Aged creditors report. The answer is B. The statement of profit or loss tracks performance over a duration. The statement of financial position is a snapshot in time, the trial balance is an internal working document, and an aged creditors report is a specific operational list, not a primary financial statement. What is the primary purpose of recording depreciation in accounts? Depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. It is an application of the matching principle, which dictates that expenses should be recorded in the same period as the revenue they help generate. Key concepts. Useful life, the period over which an asset is expected to be available for use. Carrying amount, the original cost minus accumulated depreciation. Non-cash expense, depreciation reduces profit but does not involve an actual cash outflow. Here are the options. A. To reflect the actual market value of an asset. B. To spread the cost of a tangible asset over its useful life. C. To save cash for future asset replacement. D. To reduce the amount of VAT payable. The answer is B. Depreciation is an accounting allocation method, not a valuation tool for market price. It does not involve setting aside cash, nor does it directly affect VAT, which is a separate tax reporting requirement. Select the items that would be found under Current Assets on a balance sheet. Select all that apply. Current assets represent resources owned by a business that are expected to be converted into cash, sold, or consumed within 1 year or one operating cycle. They are essential for maintaining day-to-day liquidity. Cash at bank, the most liquid asset, representing funds immediately available. Inventory, goods held for sale or in the process of production. Trade receivables, amounts owed to the business by customers for goods or services provided on credit. In contrast, patents and trademarks are classified as intangible non-current assets because they provide long-term economic benefits beyond a single year and are not intended for immediate sale. Choose between A. Cash at bank. B. Inventory. C. Trade receivables. D. Patents and trademarks. The answer is A, B, and C. Cash at bank, inventory, and trade receivables are all short-term resources expected to be realized within a year. Patents and trademarks are excluded because they are long-term intangible assets. What is the primary function of preparing a trial balance? A trial balance is a bookkeeping worksheet that lists the balances of all ledger accounts at a specific point in time. Its primary purpose is to verify the mathematical accuracy of the double entry system. By ensuring that the total of all debit balances equals the total of all credit balances, the accountant confirms that the fundamental accounting equation, assets equals liabilities plus equity, remains in balance. It serves as a preliminary step before preparing final financial statements. Let's review the options. A. To prove that no errors exist in the ledgers. B. To check that the total value of debits matches total credits. C. To determine the closing cash balance. D. To calculate the tax liability for the year. The answer is B. The trial balance only checks arithmetic equality. It cannot detect errors of omission, principal, or original entry. It is not used for tax calculations or determining specific cash balances. In the UK, what is the standard rate of value-added tax (VAT)? Value-added tax (VAT) is a consumption tax placed on a product whenever value is added at each stage of the supply chain, from production to the point of sale. In the UK, there are 3 main rates. Rate type percentage. Standard rate 20%. Reduced rate 5%. Zero rate 0%. The options are A. 5%, B. 17.5%, C. 20%, D. 25%. The answer is C. 20% is the current standard rate of VAT in the UK. The other options represent either historical rates or reduced rates applied to specific categories of goods. Which statement best defines drawings? The business entity concept dictates that a business is a separate legal entity from its owner. Therefore, when an owner withdraws cash, inventory, or other assets for their own private use, this is recorded as drawings. Drawings are not a business expense. Rather, they represent a reduction in the owner's equity in the business. They are typically deducted from the capital account at the end of the accounting period. Here are the options. A. Expenses paid for by the business on behalf of staff. B. Resources taken from the business by the owner for personal use. C. The introduction of new capital by a partner. D. Bank charges for overdraft facilities. The answer is B. Drawings specifically refer to personal use by the owner. Business expenses, capital injections, and bank charges are distinct financial activities that do not involve personal appropriation of assets. The accruals concept, matching principle, requires that. The accruals concept, or matching principle, is a fundamental accounting pillar that ensures financial statements accurately reflect performance. It dictates that revenue and the costs incurred to earn that revenue must be reported in the same accounting period, regardless of when the cash actually changes hands. Revenue recognition, recorded when earned, not when cash is received. Expense recognition, recorded when incurred, not when paid. This approach prevents the distortion of profit figures that would occur if cash basis accounting were used. Here are the options. A. Revenue is only recognized when the customer pays cash. B. Expenses are matched with the revenue they help generate in the same period. C. Fixed assets are always recorded at market value. D. Liabilities are only recorded when an invoice is received. The answer is B. Matching expenses to the revenue they generate ensures profit is accurately reported for a period. Other options describe cash basis accounting or incorrect valuation methods. What is the double entry for a sales transaction made on credit? In double entry bookkeeping, every transaction affects two accounts to keep the accounting equation, assets equals liabilities plus equity, in balance. When a sale is made on credit, the business has not yet received cash, but it has earned revenue and gained a legal right to collect money from the customer. Trade receivables, asset increases because the customer now owes the business money. Sales, revenue increases because the business has fulfilled its performance obligation. Refer to the diagram on screen. Let's review the options. A. Debit sales, credit cash. B. Debit trade receivables, credit sales. C. Debit sales, credit trade receivables. D. Debit bank, credit sales. The answer is B. Debit trade receivables increases the asset, and credit sales records the revenue. Options involving cash or bank are incorrect because the sale is on credit, not for immediate payment. What happens when a debt is classified as bad in accounting? A bad debt occurs when it becomes clear that a customer will not pay the amount they owe. Under the accrual basis of accounting, the business must recognize this loss in the period it is identified as uncollectible to ensure the statement of profit or loss reflects the true financial performance. When a debt is written off, the trade receivables balance is reduced credit. A bad debt expense is recognized debit to reduce profit. Here are the options. A. It is moved to a long-term liability account. B. It is written off as an expense in the statement of profit or loss. C. It remains in trade receivables until paid. D. The business sues the customer immediately. The answer is B. Writing off the debt as an expense correctly reduces the profit for the period. Leaving it in receivables overstates assets, and suing or moving it to liabilities does not reflect the accounting reality of a loss. According to IS2, inventory should be valued at. IS2 inventories dictates that inventory must be measured at the lower of cost and net realizable value, NRV. This is a direct application of the prudence concept, which prevents assets from being overstated on the balance sheet. Cost: the purchase price plus costs to bring the inventory to its present location and condition. Net realizable value, NRV, the estimated selling price in the ordinary course of business, less the estimated costs of completion and the estimated costs necessary to make the sale. If the market value drops below the cost, the business must recognize the loss immediately. Here are the options. A. Market selling price. B. The lower of cost and net realizable value. C. The higher of cost and market value. D. Original purchase price regardless of damage. The answer is B. Valuing at the lower of cost and NRV ensures assets are not overstated. Using market price or higher values violates the prudence principle by anticipating potential gains that haven't been realized. Under the impress system, what is the purpose of the float? The impress system is a method of controlling petty cash. The business sets a fixed float amount, e.g., $200. Throughout the period, small expenses are paid from this cash, supported by vouchers. At the end of the period, the cashier reviews the vouchers and reimburses the exact amount spent to bring the cash balance back up to the original $200. Control: it prevents unauthorized spending. Efficiency: it avoids recording every tiny transaction directly in the main ledger until the replenishment stage. Let's review the options. A. To ensure there is always a variable amount of cash. B. To maintain a preset balance by replenishing the exact amount of vouchers spent. C. To allow the owner to take small loans. D. To avoid recording small transactions. The answer is B. The system maintains a fixed float by replacing exactly what was spent. Other options describe poor control or incorrect accounting practices. Which document is primarily used to record a credit sale in the sales day book? The sales day book is a book of prime entry used to record credit sales before they are posted to the general ledger. The primary source document for this is the sales invoice. Sales invoice, sent to the customer to request payment, it serves as the formal record of the sale. Purchase order, a request from the customer, not a record of a completed sale. Credit note, used to reduce the amount a customer owes, e.g., for returned goods. Remittance advice, a document sent by the customer when they make a payment to explain what the payment covers. Here are the options. A. Purchase order. B. Sales invoice. C. Credit note. D. Remittance advice. The answer is B. The sales invoice is the official document confirming the credit sale. Other documents relate to ordering, returns, or payments, rather than the initial recording of the sale. What is the function of the general ledger, nominal ledger? The general ledger, often called the nominal ledger, serves as the central repository for all financial transactions within an organization. It organizes data into specific accounts, such as assets, liabilities, equity, revenue, and expenses, to facilitate the preparation of financial statements. In a double-entry system, every transaction affects at least two accounts. The general ledger provides the structured framework to record these debits and credits, ensuring the fundamental accounting equation, assets equals liabilities plus equity, remains in balance. The options are: A. To keep a list of individual customer balances. B. To act as the master set of accounts for double-entry bookkeeping. C. To store physical copies of all receipts. D. To track the hours worked by employees. The answer is B. The general ledger is the master record for all accounts. Individual customer balances are kept in a separate sales ledger, while physical receipts and employee hours are operational records, not part of the core double-entry bookkeeping structure. Why would a business perform a bank reconciliation? Bank reconciliation is a vital internal control process that compares a business's internal cash book records against the official bank statement provided by the financial institution. Discrepancies often arise due to timing differences, such as unpresented checks, payments recorded by the business but not yet cleared by the bank. Outstanding lodgements, deposits recorded by the business but not yet processed by the bank. Direct debits/bank charges, transactions processed by the bank that the business has not yet recorded. The options are: A. To calculate the total sales for the month. B. To identify and explain differences between the cash book and bank statement. C. To ensure the bank pays more interest. D. To prepare the budget for the following year. The answer is B. Reconciliation ensures the accuracy of financial records by identifying timing differences and errors. It is not used for calculating sales, influencing interest rates, or setting future budgets. Identify which of these items are typically non-current assets. Select all that apply. Non-current assets are long-term investments or physical assets that a business expects to hold and use for more than one accounting period, typically over a year. They are not intended for immediate resale. Common examples include tangible assets, physical items like machinery, vehicles, buildings, and computer hardware. Intangible assets, non-physical items like patents, trademarks, or goodwill. In contrast, current assets, like accrued income, are expected to be converted into cash or consumed within a single operating cycle. Possible answers are: A. Motor vehicles. B. Computer hardware. C. Accrued income. D. Plant and machinery. The answer is A, B, and D. Motor vehicles, computer hardware, and plant and machinery are long-term assets used in operations. Accrued income is a current asset, as it represents money owed to the business that is expected to be received shortly. Which formula correctly determines the cost of sales for a retail business? The cost of sales, or cost of goods sold, represents the direct costs attributable to the production or purchase of the goods sold by a business. To calculate this, we use the following logic. Start with opening inventory, what you had at the start. Add purchases, what you bought during the period. Subtract closing inventory, what you have left over at the end. This calculation isolates the cost of only the items that were actually sold during the period. Possible answers are: A. Opening inventory plus purchases, closing inventory. B. Opening inventory, purchases plus closing inventory. C. Sales, net profit. D. Purchases plus carriage outwards. The answer is A. The formula correctly matches the flow of inventory, beginning stock plus additions minus remaining stock. Other options incorrectly manipulate these variables or include unrelated costs like carriage outwards. How is net profit derived in an income statement? The income statement, or profit and loss statement, follows a tiered structure to determine the final profitability of a business. Gross profit, calculated as revenue minus cost of sales. It shows the profit made from trading activities alone. Net profit, calculated by taking the gross profit and subtracting all remaining operating expenses, such as rent, salaries, utilities, and depreciation. Net profit represents the bottom line, the actual profit remaining for the business owners after all costs of doing business have been accounted for. Here are the options. A. Revenue minus cost of sales. B. Gross profit minus operating expenses. C. Total assets minus total liabilities. D. Sales minus drawings. The answer is B. Net profit is the final figure after all operating expenses are deducted from gross profit. Revenue minus cost of sales is the definition of gross profit, while assets minus liabilities defines equity. When a business pays a credit supplier by electronic transfer, what is the entry? In double-entry bookkeeping, every transaction affects at least two accounts. When paying a supplier, you're reducing a liability, trade payables, and reducing an asset, bank. Trade payables are liabilities. They increase with a credit and decrease with a debit. Bank is an asset. It increases with a debit and decreases with a credit. Choose between A. Debit bank, credit trade payables. B. Debit trade payables, credit bank. C. Debit purchases, credit bank. D. Debit cash, credit trade payables. The answer is B. Debiting trade payables reduces the amount owed to the supplier, and crediting the bank account reflects the outflow of cash. Other options are incorrect because they either increase liabilities, A, or incorrectly treat the payment as an expense, C, or cash transaction, D. In the context of a sole trader, what does capital represent? Capital represents the owner's stake in the business. It is defined by the fundamental accounting equation. Assets, liabilities equals capital. This reflects the residual interest, what would be left for the owner if all assets were sold and all debts were paid off. Choose between A. The total amount of cash held in the business safe. B. The owner's residual interest in the assets after deducting liabilities. C. The money borrowed from a bank to start the business. D. Total turnover for the current year. The answer is B. Capital is an equity concept, not a measure of physical cash, A, debt, C, or revenue, D. It specifically represents the owner's claim on the business's net assets. What is input tax for a VAT-registered business? VAT, value-added tax, is a consumption tax. Businesses act as collectors for the government. Output tax, VAT charged on sales, collected from customers. Input tax, VAT paid on business purchases, reclaimable from the tax authority. The net VAT payable to the government is the difference between output tax and input tax. Choose between A. The VAT charged on sales invoices sent to customers. B. The VAT paid on goods and services purchased by the business. C. Tax paid on the importation of services from the EU. D. Corporation tax on business inputs. The answer is B. Input tax is specifically the tax paid on purchases. Option A describes output tax, while C and D refer to different tax categories entirely. Which of these errors would lead to the trial balance failing to balance, total debits not matching total credits? A trial balance lists all ledger balances to ensure that total debits equal total credits. Errors that cause an imbalance are those that violate the double entry principle, e.g., entering a debit twice. Errors that do not cause an imbalance include omission. The transaction is missing entirely. Principal. Recording in the wrong class of account. Commission. Recording in the wrong account of the same class. Reversal. Debiting and crediting the correct amounts, but to the wrong sides. Possible answers are A. A transaction completely omitted from the books. B. An entry made as a debit in two different accounts, transposition error. C. A transaction recorded in the correct side, but the wrong class of account. D. The same amount entered correctly as debit and credit, but in the wrong accounts. The answer is B. Entering a debit in two different accounts results in a total debit value that exceeds the total credit value, causing the trial balance to fail. The other options involve errors that maintain the equality of debits and credits. What is the accounting purpose of a credit note issued to a customer? A credit note is a document issued by a seller to a buyer. It acts as a negative invoice. It is used to adjust the balance of a customer's account downward when goods are returned due to damage or defects. There was an overcharge on the original invoice. A trade discount was omitted from the original invoice. Let's review the options. A. To remind them that their payment is overdue. B. To record a reduction in the amount the customer owes for returned or overcharged goods. C. To increase the interest charged on a credit account. D. To offer a discount on their next purchase. The answer is B. The credit note specifically reduces the customer's debt. It is not a payment reminder, A. A fee increase, C. Or a marketing tool for future sales, D. Thanks for watching. With TestMole.com, you get everything in one place, from easy candidate invites and role-based access, to deep analytics and built-in anti-cheat mechanics. We'll assess code answers, free text responses, and issue verified certificates. Ready to simplify your hiring? Give TestMole a try. And one more thing. If you like this video and want to see more, don't forget to like and subscribe.